Welcome back to Bunnex Investment Group. In this video, we are going to talk about the Traders Dynamic Index, or basically the TDI in short. So we are going to illustrate this on TradingView, which is basically a platform that is available to a lot of traders since we are facing closure of licenses by the meta codes and so forth, and some of you trades using the prop firms. So basically, the TradingView is almost similar to the DX Trade and the C Trader or Match Trader, which are platforms that are actually coming above during this phase of time. So the first thing is to actually add the indicator. So we just go to indicators, and then we need to search for BTMM TDI. That's the one that we use, which is actually the best one. It's free, and you can actually put it on your charts. So after having it on your charts, how do we use this indicator? What's the use of this indicator? And from the title of this video is using the TDI indicator the right way. So I've seen a lot of people who actually says when this crosses, do this, when that crosses, do that. And that is all a way that is lagged. That is when you start to suffer from the lagging of these indicators. So how do we use it? The first thing is always to find the market bias. And if you have followed this channel for quite a long period of time, you know that we use the institutional market maker method, which actually uses levels counting to find the market bias. So we are going to go back in history so that we can mark how and where we were going to actually make some entries using the Traders Dynamic Index. Mind you, we are already in a sell on this particular trade, which is USD/JPY. This is to hash those people who would say we are actually trading in hindsight. That is why we are doing it the right way. So the first thing is actually to reach the points of market reversals, or the points where you expect action within the markets. We usually like to call those points of market interest. So in this particular case, we can see that the market was actually trending in an upward wave, whereby we had the first level to the upside, which is this one, and then we had the next level that started from this particular point to that particular point, and then we had the third level to the upside, which is this one to the upside, like that. So 3 levels of rise or 3 levels of drop we expect to see the market to reverse, and in this particular case we can see the market actually made a reversal. After the market reverses, the next thing is to find what we call a reset. So this is actually a background of how we build the bias, not necessarily how we are going to be trading using the TDI in this particular instance. So first cycle was issued and we had a reset structure, and then we started again to see the second cycle starting first level, and then we had the second level, then we had the last level to the upside, which was this one. So 3 levels to the upside, we expect to see a market reversal. At level 3, we expect to see the market chop. Therefore, after every level to the downside or to the up, after every 3 levels to the downside or to the upside, we can get a pattern, since it's actually a point or a phase of consolidation. So we can now go to the M15 time frame to see what was taking place within that particular zone. So all that counting of levels on the higher time frame was actually a way to show you how we count levels. Basically, we'll be looking for higher highs and higher lows, higher highs and higher lows, like that. So on that particular level 3 that we had, we expect to first create the third, to create what we call the first leg, and then we expect to create the neckline, and from that neckline we expect to create the second leg. So from this particular point, this is the point that we highlighted on the H4 time frame. What did the market do next? We can see that the market actually made a drop, made a lower high. Then from that lower high, where did it break? It broke at this particular point to create this particular choppiness. This was actually an unnameable structure. So there was no trade within that particular move. Then going forth, we can see the choppiness and so forth. And within those choppiness, we can see that this particular point, which was now at the same level as the first leg. From that, we can see there was a drop, consolidation, drop, consolidation, and at this particular point, we had some sort of a W pattern. So the W patterns that comes and where we use the TDI is to confirm what we call divergence. We need to see opposite illustration of the markets or the price chart and the traders dynamic index. Like in this particular case, we can see the level of the first leg and then the level of the second leg was actually different to what the TDI was actually showing us. We can see the level of the first leg was actually lower than the level of the second leg, meaning that we had divergence. A valid form of divergence within the market context is actually a point of market entry. Therefore, this was actually a good point of market entry, which was a buy. So that is the first way of using the traders dynamic index. In this particular case, we can see from this W pattern, we had another three-wave move. A three-wave move that can be seen. And for the VIP members, we actually had a sell at this particular point. How did it come? We had a move to the upside, a pullback. Actually, you can say this was the first pullback, but the market did not break again, and it later broke on this particular move, a pullback to the upside like that. So counting the levels like how I've illustrated earlier, we can safely say this was the first level. Then we had the second level. This is on the M15 time frame. And then we had the third level, right? Then after that, we need our TDI in place. Our TDI will show us whether the market is giving us a valid pattern or a valid move. We can see that we had the first leg. The first leg was actually at this particular point, and then the second leg was actually in this particular point. An opposite illustration of price and the traders dynamic index. So basically telling us that this is a powerful point of reversal. That is where we actually made a sell, and then this gave us this drop to the downside. So from this particular point to the upside, we can see there was no segments that we look for. We always want to have a third level that is clear. From there, we can see from that particular point to the upside, where we can see we had first level, consolidation, then second level that was issued, and then the third level. What can we see after third level? We had first leg, pullback, and then second leg. Was there in a divergence or opposite illustration of the price and the TDI? Yes, we can see that we had a rise here and we had a drop here. The greater the divergence, like in this particular case, the greater the sign of market is going to reverse. So basically what we will be looking for are two things. We need to attain the bias. After attaining the bias at the third level or at reversal points, that is where we need to look for the divergence using the traders dynamic index. So if you can see, the TDI is not helping us to predict anything, but it is helping us to see where manipulation is taking place, where the market is actually rising whilst the sentiment is actually dropping. So if we spot those points within the markets, if you backtest all those points, you'd see that you'll be 70 to 75% accuracy. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.